Hello, and welcome to our Money Facts channel. Today, we'll discuss 7 secret ways rich people use debt to make money. How debt can help you amass wealth over the long term. Contrary to popular belief, you can increase your wealth by taking on debt, especially if you do so wisely and with a specific goal. In this video, we'll look at 7 strategies that could improve how you use debt to build long-term wealth. It's crucial to describe the distinction between effective and ineffective debt. Inefficient debt is typically connected to assets that lose value over time and have little chance of generating income or providing tax advantages. Debt like a car loan or using a credit card to pay for a vacation are examples of this. On the other hand, efficient debt is borrowed to buy assets with the potential to increase in value or produce revenue that can be utilized to pay off the debt. These assets include, for instance, real estate, stocks, and other instruments like managed funds. Over the long run, this debt can enable you to amass true wealth. There are 7 different ways the wealthy borrow money. Although debt is an effective instrument for generating income, many people shun it like the plague. However, the reality is that most wealthy people use debt to increase their wealth, and you may do the same in various ways. In this video, I'll describe how wealthy people utilize debt as a tool to invest in themselves and their future. 1. Borrow money to buy assets that generate income. Debt can also be used to purchase assets that generate revenue. One of the most typical ways wealthy people use debt is in this way, which is another way they invest in their wealth. You can use debt to purchase assets that generate cash flow or recurring income. That is why a lot of people opt to purchase rental houses. You get an excellent return on investment with debt. Plus, you get the bonus of being able to collect rent from your property each month. 2. To buy investments, they borrow money. For instance, if you want to buy a house with $100,000, you will need to save up at least $50,000 in cash, since no bank won't grant you a mortgage for less than $50,000. However, you utilize debt to pay for your home, which could be worth $1 million or more, depending on the market. In that case, you can use your modest initial investment as collateral and borrow up to 90% of the property's value. Banks will be more willing to lend more money than they otherwise would have been able to without taking on any additional risk, because this assures them that they can recoup their losses if something goes wrong with their loan. Debt gives those who, like most people, don't have enough money right now access to investments and other possibilities that they may otherwise have to wait for later in life when they have accumulated more savings through intelligent spending habits. 3. They utilize debt for tax advantages. The wealthy also use debt to profit from tax breaks. They take out a loan and invest the money in mutual funds or stock in commercial real estate. Losses can be offset by other income if they sell the investment at a profit. Net operating loss carried forward refers to this. They can also lower their taxable income by contributing to charities from their IRA accounts. The same deduction applies to these gifts as monetary contributions made directly to charities. 50% of the gross income after adjustments. 4. They leverage their time and experience by taking on debt. Debt is another way wealthy people generate income by leveraging their time and experiences. When a wealthy person borrows money to purchase an investment property, that illustrates how this works. They then rent out the property to generate money. Still, because they have engaged a property manager to take care of repairs, upkeep, and other issues associated with successfully maintaining the rental, they can save time managing it. This indicates that the wealthy individual is not occupied with activities like maintaining restrooms or resolving tenant disputes. They concentrate on their businesses or other interests instead. Another instance would be taking on debt to pay off college loans more quickly so that you can earn more money sooner than you would otherwise. 5. They lower their risk by taking on debt. They make investments in things that will gain value. For instance, you might get a loan to buy a house in a neighborhood with good schools. Although you won't be able to sell this property for as much as comparable properties in the neighborhood, the additional funds you'll be contributing each month to your mortgage will go toward paying off your loan and generating interest. Thanks to their excellent education, your children will have improved employment possibilities when they graduate from college and join the workforce. This means that when you sell them your house, They'll make more money overall than someone who went to a less adequate school system, and you will too. Or maybe they take out a loan to buy an apartment complex with great tenants and steady rentals that will probably go up over time owing to inflation. We are employing leverage, borrowing, and paying off any outstanding debt with rental income. The rent these tenants have paid. Real estate investing allows investors to become wealthy without investing any of their own money. 6. Obtaining credit to generate income. The best way is this one. Debt is one way that wealthy individuals make money. They employ it to expand theirs. Here are a few instances of how you can borrow money and use it to build wealth. Margin trading allows you to purchase stock in a company and then borrow money against the shares. For example, you could buy government or municipal government-issued bonds. You could invest in real estate by using your funds to buy a rental home or commercial building, then taking out a mortgage on it as security for additional loans from banks or private investors who want to fund you because they have confidence in your ability to repay their loans over time with interest. Starting a small business with your own money and a few loans from family and friends to get things going would allow you to grow it to the point where banks are willing to lend significant sums of money against your company's value, further increasing its value. 7. Diversify your investment portfolio. They distribute the risk over several different ventures by using loans to diversify their investments and reduce them. Of course, debt also has the advantage of allowing you to diversify your investment portfolio. You should invest most of your funds when you're just starting and establishing your fortune to earn a high return and expand significantly. However, what happens if everything is in one basket and something goes wrong? The value of that one investment might dramatically decline in the event of a stock market disaster. If this occurs, you can lose everything in an instant. Spreading risk among several investments enables diversification because no single investment bears the entire risk or return. By spreading investments across many industries or regions, such as stocks from various countries, diversification can help avoid this scenario and reduce risk by preventing all of one's assets from being invested in one particular type or location at once. This video has given you a better understanding of the various types of debt and how to avoid them. Debt is a risky game that can lead to significant financial issues for everyone participating. If you are currently in debt, we recommend that you do what is. There's no more video left to watch. Please comment, like, and subscribe. Enjoy your day, and thanks for watching.